Okay, today we're going to talk about trading the Fed funds futures, and ideally we're going to talk about what you really need to know. Now, it might sound like a completely genius move to schedule this particular webinar at this particular time on a Fed funds, on a Fed FOMC day, right after Janet Yellen ends her press conference, but to be honest, it was a little bit random. I scheduled it without even checking my economic calendar or thinking about it, so today's our lucky day. It's a great topic for the current situation. For those of you that don't know me, my name is Carly Garner. I'm with DeCarley Trading. We are a brokerage firm in Las Vegas, Nevada. We're actually a division of Zaner. You've probably heard of Zaner. They're one of the biggest and oldest IBs in the commodity industry. If you're on social media, check us out on Facebook, Twitter, Instagram. Just search either Carly Garner, or actually on Twitter it's @CarlyGarner, or if you search DeCarley Trading, we'll come up. As my intro alluded, I've written 4 books. The first book was Commodity Options in 2009. I've since written a couple more. My newest book, Higher Probability Commodity Trading, will be out on July 19th of this year, so we're super excited. Although it's not officially released yet, you can pre-order it off of our website, higherprobabilitycommoditytradingbook.com. That's a mouthful. Or you can even pre-order it on Amazon starting today, so we're super excited. This is where I remind everybody that trading is substantially risky, whether you're trading futures, options, which is what we'll be talking about today, or securities or Forex or anything else. It's not suitable for everybody. Okay, let's get started. We'll start with what are the Fed funds futures. The most common assumption is that people, well, probably because if you're watching television news stations, you'll hear people, newscasters or commentators basically talk about the Fed fund futures, and they imply that it's some sort of predictor of what the Fed fund futures rate or what the Fed might do in the future, but that is absolutely not the case. The Fed fund futures do not tell us the futures. They are simply futures contracts, basically trading vehicles, in which hedgers, but mostly speculators, buy and sell according to their market outlook. So in other words, it's not unlike any other futures contract. When people buy or sell the E-mini S&P, for example, if they're trading the September E-mini S&P, essentially what they're trading is the expectations of what the S&P will be in September. It's no surprise that the September E-mini S&P generally moves with the cash S&P or with the stock market in general. So just because technically the September S&P future is telling us what people are going to think the S&P will be in September, it really has no predictive value because it accumulates all of the market participants' opinions today, but we know those opinions can change dramatically minute by minute. Fed funds futures traders are doing the exact same thing. Market participants are merely making educated guesses as to what the Fed might do. While most traders of the Fed fund futures are highly sophisticated, it is important to recognize they can be and often are wrong. We're going to talk about the current situation today. The Fed is telling us one thing, but the Fed fund futures market is telling us a completely different thing. So who's wrong? Is the Fed wrong or is the market wrong? Only time will tell. But there is absolutely no certainty in regard to anything that we see going on in the Fed funds futures. People are just making wagers, and this is the outcome. What exactly is a Fed fund futures contract? For those of you that are coming from the stock side of things, this might be a little bit new to you. Basically, the Fed fund futures are derivative contracts written with the FOMC's target overnight bank lending rate as the underlying asset. And I use the term asset loosely because obviously it really isn't an asset. It's more of an idea or a concept or an opinion, projection, whichever word you want to use. But that's really all it is. The expiration months are based on scheduled Fed meetings, not quarters, as most other financial futures products are. So if you are familiar with futures trading, you know that the E-mini S&P or the Treasury futures or currency futures, they're all quarterly contracts, meaning they expire in March, June, September, December. Well, Fed Fund futures expirations are not quarterly like the other contracts. They basically have expiration months around the Fed Fund meetings. However, you know, the Chicago Mercantile Exchange, they're good at what they do and they know how to make money. So they've actually filled in the other months, and that you will find Fed Fund futures months that expire in a month that doesn't have a Fed meeting. But it's good business, what can I say? Fed Fund futures can be bought or sold in any order. This might also be new to stock traders, or at least the convenience of it. Unlike stock traders who have to borrow shares from their brokerage firm and then they have to pay interest and all these other things, the futures trader can simply buy or sell based on their opinion with no interest charges, no penalties, you know, no permission. They just do it. They click a button. So if you think the Fed funds will, or I'm sorry, if you think the Fed will raise rates, you would go short a Fed Fund futures contract. If you think the Fed will lower rates, you would go long a Fed Fund futures contract. It's that easy. It's not unlike, you know, they have fantasy leagues that bet on who's going to win the Super Bowl. It's really not unlike that. We're guessing, you know, which team is going to win, and it's a wager on an event occurring, and that's really kind of the gist of it. Okay, let's talk about the contract specs for Fed Fund futures. The symbol for the Fed Fund futures contract is ZQ. Again, DeCarley Trading, we are a futures broker, so we offer these products to our clients. If you happen to be trading with a stockbroker that offers futures on the side, the symbol will be the same. You just type in ZQ into your platform and it'll pull up the available months. As a side note, this is my personal opinion, and I'm a broker, so take it for what it's worth. But my opinion is, if you really truly want to trade futures and options on futures, you should do it with a futures broker. A lot of stockbrokers, like I said, will offer it on the side, but it's really truly not what they do. It's a side product. They offer it for convenience, but they restrict a lot of the trading months. They charge higher margins. You know, it's just not their specialty. Anyway, Fed Fund futures contract is cash settled, so there's no delivery of an underlying asset, because there really isn't an underlying asset, although if you read the contract specs on the CME's website, the Chicago Mercantile Group's website, they'll tell you the underlying asset is basically $5 million on deposits, you know, accruing overnight interest. But truly, it's really kind of a, I don't want to say mythical, but yeah, mythical kind of asset. So anyway, if you do happen to hold this particular contract all the way to expiration, which I wouldn't recommend doing, but if you did, it would be cash settled. In other words, the exchange would say, okay, here's where we estimate the settlement price of this contract to be, and then they adjust your futures account accordingly by either adding money to it or subtracting money to it. 99.9% of the speculators out there will offset their futures contract before it gets that far, and that's the smart thing to do. It's hard enough to make money in the markets. The last thing you need is really being subject to some arbitrary calculation at expiration that, you know, you have no control over. The margin on a Fed Fund futures contract is generally below $1,000. You know, margin fluctuates with market volatility and those types of things. And the CME actually does charge less margin for the front month than it does the back months, and we'll tell you why they do that soon. But generally, you're looking at about $800 in margin for one contract. So it's a really affordable way to play interest rates. And as we're going to show you in a few minutes, it's relatively low risk as well when you compare it to some of the other contracts like the 30-year bond or the 10-year note. The Fed Fund futures contract is going to move a lot slower, even though it's based on $5 million. Because let's face it, the Fed Funds futures, or I'm sorry, the Fed Fund target rate really does not change that much, and when it does, it's at a slow and measured pace, or at least that's what Janet Yellen tells us. each point in the Fed Fund futures is worth $41.68. For the life of me, I can't figure out really where they came up with that number. I'm assuming it's some sort of, it's maybe a basis point on a $5 million account, but if I try to do the math, it doesn't wash out. So, exchanges are funny like that. Sometimes they just have really super smart people that do really kind of silly things like this. The tick value, so every tick that the futures market moves, a trader will make or lose $20.83.5. So, it seems a little more complicated than it needs to be. In my opinion, they could have made it 20 bucks even, and we would have all been happy. But it is what it is. Contract size, like we mentioned, it's 5 million. So a trader that's buying or selling a Fed Fund futures contract with a margin of 800 is actually controlling, for lack of a better word, $5 million worth of cash on deposit, earning the overnight bank rate. I probably answered my own question. I bet if you figured out half of a basis point on 5 million overnight, I bet is about $20.84 in interest. Anyways, you get the point. The distant expiration months move a lot faster than proximal months, and they trade around the clock. Fed Fund futures go 24 hours a day. So it's a great way to not only speculate in the interest rate market with low risk and low margin, but you can do it around the clock. If you wake up in the middle of the night and you see something crazy is going on in Europe, maybe the Brexit, you can always change your position. You don't have to wait for the stock market to open. Generally speaking, however, the Fed Fund futures are pretty slow movers, and this is just an example of what you might see while you're trading these things. You'll notice in this general area, see if I can get a pen. In this general area, the market basically traded for roughly a little more than 3 months in a $700 range. So obviously, if you would have bought the lows and sold the highs, you could have made some good money. But if you were just a buy and hold investor or a sell and hold investor, and you never got out or took profits, you wouldn't have made or lost much of anything per contract. Generally speaking, that's probably what you're looking at when you're trading Fed Fund futures. You're not going to get rich doing this, but you're probably not going to get poor either. And for a lot of us, that's definitely an attractive characteristic of the market. Now, you'll notice here I point out over here that the Fed Fund futures made basically a $2,200 move in a little over a month. Well, let's think back of what was going on in January. In December, the Fed raised rates, and everybody was on track we kind of assumed that the Fed was going to raise rates at least 4 times in 2016, and the market was pricing that in. In fact, the market was pricing in more than that. And suddenly, we had crude oil collapse, and the entire commodity complex collapse, and all heck was breaking loose in the financial markets. And so suddenly, Fed Fund futures shot up and peaked here around in early February, right with the stock market, basically. That type of a move that fast and that large is pretty rare, but you also have to keep in mind that when this occurred, this is based on the November contract. So when this particular move occurred, the November contract still had a lot of time left on it. So it was considered a back month. And as I'll show you very soon, the back months move a lot faster than the front months. And this is the exact opposite of what, if you've ever traded commodities, corn, soybeans, anything like that, the front month is usually the most volatile and the back months are a little tamer. Well, in financials, it's the opposite. The front months are quiet and the back months are volatile. So for the whole point of this, for the most part, Fed Fund futures move pretty slow. So it's a great place if you've never traded futures before and you're maybe looking to get involved, or you want to play, speculate on interest rate changes. This is a really fabulous contract to do it because it's pure, it's liquid, and your risk isn't going to be very high. Okay, this is just kind of giving you an idea of what I'm talking about when I say the back months move quicker. On the upper, I guess it's the upper left side for you guys. I would assume it's the same. So the upper left side, this move occurred on June 3rd. It was a big rally in Fed fund futures, and it coincidentally was a big rally in basically all the interest rate products, so Treasury notes, Treasury bonds, etc. But this is the January of 2017 contract. Oh, I apologize. August of 2017 contract. So this Fed fund contract expires a year from now, roughly. Actually, a little more than that, but you get the idea. And on January 3rd, it moved 10.5 points. I apologize. June 3rd, it moved 10.5 points. On June 3rd, the July of 2016 contract, which is expiring shortly, moved 4.5 points. So you can see the back month moved twice as fast as the front month. And remember, we said the point value is roughly $40.80, or we'll just call it $40 just for simplicity. So this particular move in January would have been about you would have made or lost about $400 in one single day, which is a lot of money, don't get me wrong, but trust me, if you've ever traded futures, you know $400 in a lot of other markets, such as the E-mini S&P or Treasuries, is really kind of a blip, and you see that kind of a move in 5-10 minutes all the time. So again, this is just a slower moving vehicle. If you would have been trading the front month of Fed fund futures instead, you would have made or lost roughly 160 to 200 bucks. So this is, and that's a volatile day, and that's the whole point of this slide. Those are volatile days in this particular contract. Most days, you're only going to see 1, maybe 2 points of movement. So you're talking, you might make or lose 20, 40, 60 bucks in a day. I'm just trying to give you an idea of how fast they move, and maybe the better description is how slow they move. But slow is good, because guess what? It pulls your emotions out of things, and it gives you the ability to play long-term prognosis or opinion without the stress or sleepless nights that you might get on some of the more volatile futures markets. So are we looking at a historical opportunity in the Fed funds futures markets, or is this a trap? Well, today was somewhat of an answer to that. Basically, the Fed funds futures is a discount bond, and if you're unaware of what a discount bond is, it basically means the value of it trades at 100 minus the current interest rate. So the current Fed funds target rate, excuse me, the current Fed funds target rate is 0.25% to 0.5%. So if we're talking about, we'll just go with the 0.5%, the currently expiring Fed funds futures should be about 99.50. 100 minus the 50 basis points, we come up with 99.50 as the value. So again, 1 point minus the Fed funds futures price equals the inferred interest rate. If the Fed funds futures is trading at 99.50, it's pricing in expectations of the Fed funds futures rate at expiration being 50 basis points. So we know, based on that equation, for the Fed funds futures to trade above 99.75, the market would have to believe the Fed would actually lower rates. So the Fed's actually complicated things for the Fed funds futures traders. Normally, when I say normal, I mean in a more normal interest rate environment, the Fed fund futures rate will be pretty specific. Like, for example, it might be 1%, it might be 1.25%, it might be 1.5%. But when we started getting down into the lower percentage rates, the Fed started using ranges. So we started at a range of 0 to 25 basis points, and then they bumped it up in December to 25 basis points to 50 basis points. So they're going in ranges now because, to be honest, it's impossible to pinpoint rates when you're talking about that low. So it just wasn't a big enough target for them, so they made it a range. Well, so this complicates things for Fed funds futures traders because no longer are we talking about a definitive target, it's now a range. But with that said, the current Fed fund futures, each month's a little different, but generally most of them are trading about 99.50 to 99.60 to account for at least a partial percentage probability of a rate hike, in the next 6 months or so. So if the Fed fund futures were to actually move from the current level, we'll just call it 99.50, to above 99.75, that would mean the market would actually have to expect the Fed to lower rates, not raise them. So you might be able to see where I'm going with this. In our opinion, it seems like a pretty high probability venture to be a bear in Fed funds futures because for it to get a whole lot higher than it currently is, the Fed would have to actually raise rates, or the market would have to expect the Fed to raise rates, and that's probably not going to happen. I can't say never. Obviously Europe is in negative interest rate territory, and maybe we'll eventually be there, but it's probably not likely. This chart was taken a couple of days ago after today's events. The Fed funds futures rate is actually a little higher than this, but you get the overall idea is generally the same. Anytime we've seen the Fed fund futures contract rally into the 99.60 area, general area, it generally has been a good opportunity for the bears. Even in this situation here where the market selling kind of ran out of steam, was still a good entry, and it would have given you a chance to place a stop, or it would have been at least, at the worst case scenario, a free trade. But anytime it gets up into this area, it's been a good sell. Now you're probably looking at, well, what about these times where it got all the way up here? That looks a little scary, and it is. But if you do the math, we're talking that's only about 10 points higher than where we are now. So if you sold here, hypothetically, and the market went up and retested these highs, which I got to add occurred on ridiculous market conditions. I mean, we're talking the S&P was crashing here in January. Everybody was panicking. So that sort of thing could certainly happen again. And it might. This might be kind of a rough summer in the stock market with the elections coming up and all these things going on, the Brexit. But even if that happens, a short from here would only be losing about 400 bucks. So I'm just trying to give you an idea of what the risk and reward might be. Now, if Janet Yellen today, I mean, I didn't have a lot of time to go over everything, but from what I did gather before I jumped on here, the Fed has not changed their expectations of 2 rate hikes by the end of 2016. Now, the market is not pricing that in. The market is saying, bull pucky. They're pricing in like a 40% chance of 1 rate hike and a almost nil, I think below 10% chance of 2. So the market doesn't believe the Fed. But if the Fed sticks to their guns and does at least 1 or maybe 2, the Fed funds price should be somewhere down here, the 99.30s. I think, and I could be wrong, don't mark my words, but I think I saw that the Fed fund was projecting their rate to be at 0.88, which is kind of odd because they're not giving us 3/4 of a point. They're not giving us a full point. They're just saying 0.88. So if that was the case, we should see the Fed fund futures down at 99.12, even lower than this area right here. I think they're probably overshooting a little bit on that, but that's what markets are. They're opinions, and we really don't know until we know. But let's say it did go to 99.12, and the Fed was right about their year-end target rate. We're talking, depending on which contract you use and where you go with it, somebody could possibly, hypothetically, make anywhere from 40 to 50 points, and it starts to add up. Suddenly that low, slow-moving contract starts to add up. I mean, we could be talking anywhere from $1,000 to $2,000. Again, these are hypothetical ideas. I'm not making this as a recommendation. I just want to be clear. But I'm just trying to give you an idea of, this seems to be a pretty good pattern that we've picked out here, and the upside is probably limited. With that said, it's not without risk, because we never know what the future holds, ever. That's one thing that I've learned throughout my 12+ years as a broker. I can never say never. I never know what I'm going to see next. It always never fails to shock me. Okay, one tool that I wanted to point out is it's called the FedWatch, and you can find it on the CME's website. So the URL is cmegroup.com if you're interested in pulling it up. And this is like when I mentioned earlier that the newscasters and people on TV commenting on the probabilities of the next Fed rate change based on the Fed funds futures, this is what they're looking at. The CME group has set up this pretty cool little tool that will tell you what the Fed funds futures price actually means in terms of the interest rate and the probability of a future rate hike. They list all of the Fed funds futures contracts and their current price. Actually, I take that back. They don't list all of them on the FedWatch tool. They only list the ones that are associated with FOMC meetings. But like I mentioned before, the CME actually offers a contract in each and every month, regardless of a meeting or not. So I actually just ran in and grabbed this right before we started today, just to give you an idea. This is what the FedWatch looked like for the June contract, which is for the June 15 meeting today. Coming into this particular meeting, the market was only pricing in a 2% probability of a rate hike. And as we now know, that was even that 2% was a little excessive because we did not get a rate hike. But you can see over here what we're looking at. This is the target rate of, and the FedWatch keeps it simple because, you know, like I mentioned before, that the Fed has ranges, not pinpoints. It'd probably be impossible to have this kind of a tool with ranges, but they're assuming today the current range is 1/4 basis point to, or 25 basis points to 50 basis points, and they're assuming that that is basically a 0.5% rate is the current target rate instead of the range. So a 1, if the Fed raised interest rates by 1/4 point to 75, then it would fall under this category, and the current price of that particular contract, which was 99.63 1/4, would be pricing in that 1%. Let me show you one that's maybe a little more interesting. Okay. Whoops. Let me go back. All right. So if you went to the FedWatch, the first thing you would see at the top is all these contracts. And you actually, if you clicked on each one of these, it would bring up a window like this with all the proper information. So this particular slide is showing us the December contract, which the meeting takes place on Wednesday, December 14th. The current price, which I took this before today's news. In fact, this was a few days ago, you'll notice. But coming into this class after the Fed meeting and the Fed announcement, this number was not 13% anymore, it was 7. So the market is only pricing in a 7% chance of 2 rate hikes in December. But I just told you the Fed is basically saying they're going to raise rates 2 more times. So we've got a little disconnect here. It'll be interesting to see who's right and who's wrong. Ultimately, obviously, it's the Fed that makes the decision, so hopefully they are a little more informed than the market participants that are pricing in these probabilities according to the FedWatch and the Fed funds futures. But then again, you know, we never know until we actually know, until after the fact. But if you look at some of the previous charts that we posted of the Fed funds futures, it's obvious that market participants change their mind a lot. So during all of that time, remember I showed you the Fed funds futures market was trading in a $700 range for 3 months. Well, that $700 range, we saw the top and the bottom a couple of times. The Fed never raised or lowered rates at any point during that 3 months. The market just changed its mind. And also on the FedWatch, if you notice, unfortunately the slide's a little cut off, but this shows the current rate, which is 0.5%, and then if they do one rate hike, it'll be 0.75%. And according to this slide, they were pricing this in at 41%. So there's a 41% chance that the Fed will raise one time. I think that I saw a glimpse on the way into here, and I think this number's dropped to about 30. So the market is currently only pricing in a 30% chance of one rate hike when the Fed is telling us there's going to be two. So again, I don't have a crystal ball. I don't know what's going to happen between now and December, but somebody's wrong here. And if you think that the market's wrong and the Fed is right, or at least partially right, might be a decent time to be bearish in this particular contract. And again, you can do it on low margin and relatively tame risk. Okay, so I appreciate everybody coming out, and I hope that you've learned something from our class. If you have any questions or anything, feel free to contact me. I'll show my contact information shortly. But again, if you like what you heard here and you want to know a little more about higher probability commodity trading, we talk about option trading, the beans, corn, natural gas, crude oil, gold, all those types of things in my latest book, and it's available for pre-order at Amazon as well as on our website, Higher Probability Commodity Trading the book, or you can go to also DeCarleyTrading.com and find the same information on the book. If you have any questions now, we have a couple more minutes. I guess I was a little quick to go through the slides, but if you've got questions, I'd be happy to answer them now. All right, I'm not seeing any questions pop up into the window. I don't know if that's good or bad, or if I'm missing something. If for some reason I didn't answer something, or you know, you do have some questions, please email me, cgarner@decarleytrading.com. Okay, somebody's asking which book would be good first if you've already have some experience. If you are relatively experienced in trading, higher probability commodity trading is exactly for you. Some of my earlier books were focused more on beginning concepts, like A Trader's First Book on Commodities is basically from ground zero and going from there. So if you're experienced and you know know the ropes, I think you'd get a lot out of higher probability higher probability commodity trading. We talk about everything from mean reversion to covered calls to ratio spreads, so all the good stuff. Do we have any other questions?
It looks like you managed to cover everything, Carly.